What does SSR mean? And what is a pop at the open and dump? Here are all the lingos that beginner traders need to understand in order to fast track your learning. If you're a new trader thinking of getting into trading, it's extremely important to start with a solid foundation. That includes creating a good trading routine, risk management, and understand that becoming profitable will take months and years. There's definitely no fast Lamborghini money in trading. So in order to do so, we must have a solid understanding of all the day trading jargons. What is a heavy polling price action? And what does ETB and SSR mean? And how do they contribute to a short squeeze? So by the end of this video, you'll understand the fundamental terms in trading, as well as the more complex and advanced terms that experienced traders use. And don't worry, there will be plenty of bad jokes sprinkled throughout the entire video to make it entertaining. As long as you remember to drop a like on the video. Doing so will make my bad jokes a little bit funnier. Just a little bit though. So let's start with the basics first. Longing and shorting. What does that mean? Longing a stock means you're buying a stock and you're betting that the stock price is gonna go higher. And going short means borrowing shares from your broker to sell, meaning you're betting on the stock price dropping lower and you would then profit from the difference. So let's say you short a stock at $5 and 10 minutes later the stock drops to $2. You would then buy the stock back at $2. Doing so is called buying to cover. You're covering your short position. Your profit will be $3 now that the stock has dropped according to your plan. Make sure to donate that $3 to my Lamborghini fund. Now, technical analysis is a study of a stock's historical price movement on a chart. And you will draw the stock's support and resistance levels and other indicators for you to define the trend of a stock and make predictions on future upside or downside. You're not taking consideration of a stock's earnings, PE ratios, and the sectors. That will be considered fundamental analysis. Now, support level. What exactly is this magical support line that I've talked about so many times to buy at support? A support level is a theoretical price line that the stock has bounced off repeatedly many times in the past. So you would see that the stock has dropped to this price level and reversed the direction and going back higher. Because in the past, buyers came in to buy the stock at this lower price. Resistance level will be the opposite of a support. These are price levels that historically sellers came in to sell the stock. So you would see that the stock has had difficulty going above this resistance price level multiple times in the past. Now, very important though, a support and resistance are literally just a price level. Nothing more. It's not a secret line that bounces off. There's no secret sauce in finding the right support or the right resistance. And just because the stock has bounced off the support level in the past does not guarantee that it's gonna do the same again and again. Same as resistance. All these price levels are just theoretical and based on the stock's past performance. Next, what is a breakout? What is this easy, simple pattern that everyone is banking on in the DVDs? A breakout is when there's a sudden surge of pimples and acne on my face because I don't sleep enough, because I wake up at 4 a.m. every day, like right here. A breakout is when a stock is being bid up by the buyers and the stock price is being pushed above the previous resistance levels. Often we'll see a breakout creating a new high of the day price, which we abbreviate in trading as HOD. Now, for every single successful breakout out there, there is a fake out. A fake out is when a stock breaks above a previous resistance for like 10 cents or 20 cents and really quickly pull back down. We also sometimes call that a pop, right? Because you see the candlestick popping for like a second or 2 seconds and really quickly slam back down. And sometimes if the stock is a low float penny stock, it will pull back a lot further and quickly dump. Now, what is a dump? A dump is something you do when you're making millions of dollars day trading on a toilet. Just to be clear, while I do not own a Lambo, I do own 2 toilets. so I'm rich. A dump is a term that day traders use to describe a specific selling price action. A lot of times when we see a fake out happen in penny stocks like I described earlier, the stock will be pushed down or sold off extremely aggressively. That means there are many big sellers who want to get out of the stock. That's what we call a dump. Some similar terms that you see many traders use to describe the same price action are washes, heavy, and pull. Again, if a stock is being dumped, it seems like someone is pulling the stock down, right? And it's almost like the price is being washed off like water. That means the selling is very heavy. Often that kind of heavy selling price action could lead the stock to drop into a new low of the day, which we abbreviate as LOD, meaning the stock price is decreasing to even lower than any of the previous marks on the day. Now, if you've been following this channel for a while, you know I talk about low float penny stocks a lot. A low float stock is a kind of stock that has less than 5 million shares, generally speaking, that can be publicly traded. Oftentimes that means the stock will be extremely volatile because it really doesn't take much buying volume in order to move the stock 50% or even more than 100%. While I do trade low float penny stocks, I also trade many mid-cap and large-cap stocks as well, wherever presents the better opportunities. But if you're a new trader trying to build your small account, then trading mid-caps and large-caps might be a better option for you. I have a video for you to check that out in detail. Now, every time there's a low float penny stock going 100%, 200%, there's always a lot of people wanting to short it and betting on the stock going down. In order to short a stock, like we talked about earlier, you need to have shares to borrow from your broker. But if a penny stock is hard to borrow, HTB, then it will be hard for you to find the stocks to short. And vice versa, if a penny stock is ETB, easy to borrow, that means there's plenty of shares available out there for everyone to borrow short. With most brokers out there, such as Interactive Brokers, Thinkorswim, Questrade, and E-Trade. A lot of times when a penny stock runner is ETB, that can actually cause the stock to go even higher. Because if everyone out there has shares available to short and are trying to short it, yet there continue to be buying volume coming in to bid the stock up, the short sellers have to buy to cover, like we talked about earlier, which will add to the buying volume for the stock and make the stock price going even higher. This is what we call a short squeeze. So that means if you see a low float penny stock gapping up 50% pre-market and the stock is actually easy to borrow, you might want to be careful if you are trying to short it. The better play might be to go long instead. Another factor that could lead to a short squeeze is SSR, short sell restriction. This is a rule implemented by the SEC. If any stock, being small cap penny stock or mid cap and large cap, drops below 10% of the previous day close price, then the SSR will be triggered. This rule means that short sellers cannot add to the selling pressure by selling on the bid. They will have to short on the ask, meaning they can only go short if there are buyers bidding the stock up to buy. A very simple way to calculate what price the stock has to drop to in order to trigger SSR is this formula: previous day close price multiplied by 0.9. So if the stock you're looking at closed at $10 the previous day, then the trigger price for SSR will be $9. And yes, I did just use a calculator for that simple calculation. Not all Asians are good at math, you know. It's important to know that SSR does not directly lead to a short squeeze. It's only a contributing factor if there's a lot of fresh buying volume coming into the stock to buy it up. Now let's talk about the red to green move. When a stock is trading below the previous day close price, that means the stock is down on the day or red on the day. But let's say some buying volume came into the stock that's down on the day and the stock price is being pushed above the previous day close price. That means the stock has gone from red to going green on the day. So that's the red to green move. But of course, the green to red move will be the opposite of what I just said. A lot of times when a red to green move is successful, meaning the stock actually stays above the previous day close price, that's a psychological trigger for many buyers to come in and bid the stock up. This kind of setup is one of my favorite long setups because the risk reward is greater than 1 to 3. Now we must talk about risk reward and risk management, which is perhaps the most important concept to understand and practice in day trading. Before we enter a trade, long or short, we must assess both the upside and the downside. Part of that means, yes, thinking about where the stock can possibly go to. So maybe the stock is trading at $5 right now and you think it can go to $6. That's great and all, but most beginner traders just stop right there. There's so many marketing out there that promote making big money fast and working 1 hour a day and making millions of dollars trading from anywhere in the world. What ends up happening is that sort of unrealistic view of day trading creates a lot of FOMO, fear of missing out. And that leads a lot of new traders to jump in to buy every single stock that seems to be going to the moon. But they often overlook the downside, where the stock price can drop to if their plan was wrong, or if they didn't have a plan at all because they were following chat room alerts. So let's say that same $5 stock can drop down to $2 if the plan was wrong. That means you're risking $3 in order to make $1 on the upside. That's not good risk-reward ratio. The best risk-reward to aim for in trading is to risk $1 to potentially make $3. Well, not every single setup will give you that 1 to 3 risk reward. You definitely would want it to be better than 1 to 1. Having good risk reward on every single one of your trades is part of a good risk management. Risk management means that you have calculated the downside, how much money you could lose, and actually carry that out if you're wrong. Meaning that you actually stop out when a stock is dropping beneath a predetermined risk level. So let's say that $5 stock drops to $2 and that was your risk level. You should carry out with your original plan and stop out of that position for a loss. And that $2 mark will be your stop loss. It's important to have proper risk management and cut your loser when you're wrong, because otherwise you might become a bag holder. A bag holder is someone who is holding on to a losing position for way too long, sometimes for days, weeks, months, or even years. Instead of cutting the losers at $2 according to the original plan, the trader will keep on holding to that position, hoping that one day the stock will go back to $5. Hold and hope kills in day trading because unfortunately, many times these penny stocks will keep on diluting down from $1 to 50 cents and all the way down to single digits in pennies. I'll be the first to admit that I've done that many times in the past before, and that's what led me to blowing a few of my trading accounts when I first started. Now that you know the meaning behind most of these day trading lingos out there, you'll have a better understanding when you watch my day trading strategy and weekend recap videos. I'm sure there's more trading jargons out there that I missed, so if I missed anything, let me know in the comment section below and I'll do my best to answer. If this video helped you out, please remember to drop a like and subscribe. Thank you guys for watching as always. I'm the Humble Trader and I'll see you guys next week.